Good. Welcome, everyone. We're going to give it just 1 second for everyone to enter the room, and then we'll kick it off here. Thank you for joining us today. We'll give about 1 more minute here. Okay, excellent. Well, it's about 4 past the hour now, so we'll go ahead and kick off our presentation for the day, and people will continue to file in as it works for them. I just want to thank everyone for joining us today. The Raccoon Group is very excited to have this presentation, and we're very happy to have American Century Investments work with us on this presentation today. And today we're joined by Elaine Bourke. She is co-head of portfolio management with American Century. I had your other titles, Elaine, that said it was vice president and senior portfolio manager as well. I think I'm sure there's a whole stack of credentials in which you carry, but we're really excited to have you here today. And as people have questions, feel free to put them in the Q&A as they come up. You can also call the office at 505-989-3581, or you can always email any member of the team if you have a question and want to have that question answered during the presentation. But I am not the presenter today, Elaine is, and so we're going to go ahead and pass it over to you, and we'll get started with our investment outlook.
Thank you, Kyle. And yes, I appreciate that intro. I do have a few hats that I wear, but the most important is that I'm a member of our multi-asset strategies investment team. So we build portfolios that are really designed to navigate multiple different market environments. And I'm excited, to kind of share some of the things that we're looking at, since macro is such a key part of what we do in terms of how we're positioning our portfolios. So there are 4 themes that really seem to come up very frequently when I'm speaking with investors right now. The first is whether the Fed will kind of stick this soft landing, this narrative that we've seen in the press very frequently. The second is really around equities. We had such a phenomenal year last year that wasn't really anticipated. The question is, can we continue to see returns like that going into 2024? The third question that I get really is around fixed income. Opposite of equities, we've had a couple of challenging years in fixed income markets, but now feels like we may be at a real turning point. We have a lot of people asking, is this going to really be kind of the year of the bond? And then finally, one of my favorite questions that is completely understandable, but comes up very frequently, is around diversification. Especially when you have a really big year in equity markets, it's normal to kind of question, like, do I still need diversification? Like, why do I need it at all? So I do want to touch on that a little bit, and then of course, leaving time for questions. But maybe I can just take in the order that I kind of laid that out. what we'll talk about. So the first question really is around the soft landing. And we have a lot of market observers that are predicting a soft landing. And there's clearly signs that that's very possible, right? We've seen GDP data come in at around 5.2% last quarter. That's the fastest we've seen in 2 years. Inflation has come way down from its highs, and then the job market's still very healthy with unemployment sitting below 4%. But if you start to just dig a little bit more closely into those data points, what you'll see is that GDP growth was actually fueled by a consumer spending spree, which may not be sustainable going forward. And while inflation has come down, core inflation still sitting about 2 times above the Federal Reserve or the Fed's target. Plus, a lot of the gains that we've seen in the job market are actually coming from the government or coming from kind of, part-time work. So when you start to dig into the data, you also see that hiring has been softening a little bit, and the number of people quitting their jobs is also down, which is some indication of how confident people feel in the market. So we do still see a lot of risk in the system. And the reality here is that soft landings are actually just not that common. So you can see in this chart, of the last 12 Fed hiking cycles, we've seen 8 hard landings and 4 soft landings. And when those soft landings do happen, they tend to have around 3 things in common. You don't tend to see a big spike up in inflation. You see a modest pace of Fed tightening going into kind of the environment. And then you see an easing of bank lending standards. And today we kind of have almost exactly the opposite, right? We saw this huge spike up in inflation, very, very fast pace of tightening, and lending standards right now remain very tight. So history would tell us that a recession is probably more likely than a soft landing in this scenario. And whether that happens or not this time probably is going to depend on how proactive the Fed is in cutting rates. But at the end of the day, whether it's a recession or a soft landing really is an academic debate, because the economy is going to slow down in either scenario. So the essence of the question is, what kind of environment should we as investors be preparing for? And in all likelihood, we think there's a strong chance that it's not going to be as great. It's probably one that's going to be a little less forgiving than we have seen over the past year. So our teams think there's a very high probability of an economic slowdown here, whether it's a recession or a soft landing. We think that means growth is going to remain below trend. In a recession, trend growth would actually go negative. In a soft landing, it would just probably stay below around 1.5%. That's kind of the difference between the two definitions. Inflation, we do expect to moderate, but stay above the Fed's target. And eventually, we will begin to see the Fed cutting rates, but potentially not as fast as some people are expecting. So in this type of environment, in this slowdown scenario, investors may want to consider a few things. First, think about focusing on quality. And that applies to both equities and fixed income. So within equities, that means finding those companies that have like improving business fundamentals, really solid balance sheets that allow them to kind of weather any slowdown. Companies like Hershey's or Kimberly-Clark, right? People still buy chocolate. They still buy toilet paper in a recession. So even though those companies may not be cheap right now, they're very stable and have delivered consistent returns through multiple cycles. Also think about companies that have exposure to some of these secular growth trends like renewable energy or the expansion of 5G. They may have a competitive advantage here that can do well regardless of where we are in the cycle. And then in terms of sectors, typically less economically sensitive sectors will do better. So things like healthcare and consumer staples, With respect to consumer staples, if inflation stays elevated, those companies are probably the most likely to be able to pass along costs to customers without impacting their core businesses. So those are the types of characteristics that you want to be looking for. And I mentioned, quality within fixed income. So the same kind of general concepts apply there. An economic slowdown would likely make it harder for lower quality companies to pay back their debt. So you want to be, kind of transitioning at this point into higher quality parts of the market. And it's a great time to be thinking about this because high quality fixed income is paying what we think are really compelling yields at this point. You can get 6 to 7% with very minimal risk without even, having to reach into those lower quality parts of the market. And then another important theme within fixed income that's really worth thinking about is, adding some duration to a portfolio. So that's effectively, buying bonds that will be paid out off further in the future. I talk a little bit more about that here as we dig deeper into the fixed income opportunity set. Asset classes that may not do quite as well are things like commodities, maybe with the exception of gold. Generally, the idea of a slowdown, though, shouldn't really scare us, right? They're a normal part of the business cycle. They allow the economy to reset and they create opportunities. I think that ties well into that second question that I mentioned around, what's in store for stocks. A lot of investors are really wondering, can we sustain last year's performance into 2024? And so I think it's helpful to think about, what has historically happened at the end of a Fed hiking cycle. What's tended to happen is that markets have rallied. We've seen that, right? Rates have typically fallen. We see price to earnings or PE ratios typically rise. And investors almost always, after every Fed hiking cycle, they expect there to be a soft landing. So, just looking at where we are today, we have reached peak rates, we believe, and that's lifted markets a lot last year. And now we've started to see rates come down a bit. PE ratios have also recovered quite a bit. So this chart shows how different parts of the equity market are valued right now. Most of these sectors are trading above their historical averages. So you can see, for example, large cap growth is currently trading around 32% above average. Large cap value, a little bit more reasonable, but still 7% above its average. Small cap value stocks here are kind of one area that's actually trading at a discount. The reason that we see these high valuations is that we are also see that earnings expectations for this year are also quite high. So investors are expecting, 11% earnings per share growth in 2024. That's expecting double digit growth this year, we think is very high. So it's not totally clear how people are getting to these numbers, but it's likely that these numbers either reflect kind of easy prior year comparisons or just overly optimistic expectations. What is not priced in here at all, really, is risk. So you can see from this next chart, the top chart here is a volatility index, or the VIX. That's sitting relatively low compared to its historical average. Spreads are also incredibly tight. So when you compare, investment grade corporate bonds versus government bonds, you're getting about 1% extra yield. Aside from maybe 2021, this is actually very rare. We don't usually see spreads this tight. And what that means is you're effectively not getting paid for taking on extra risk. And at the same time that you're really not getting paid for taking on much extra risk, the US has a very dubious distinction of being the country with the highest debt to GDP ratio. It has the highest price to earnings ratio. And then we consider all of these other things like geopolitical risk and the fact that it's an election year. It's not just an election year for the US, right? About half of the world's population is going to be voting at some point in 2024. So our conclusion would be that stocks have probably gotten a bit ahead of themselves at this point. And in that type of environment, it really doesn't take much to trigger, say, a 5 to 10% pullback, which is historically quite normal for markets. So we just say, exhibit some caution here. And that's not to say that there aren't opportunities. One example of, a sector that we're looking at right now very closely would be healthcare. COVID has kind of, the concerns around COVID have really diminished. And so a lot of pent up demand for elective procedures have helped start to normalize that industry. Labor shortages in that sector have mostly improved, and we think that's going to continue. And then, that should be good news for medical technology companies, device makers, and also a lot of this, disruptive kind of new opportunities like the market's reaction to weight loss drugs have actually pushed several healthcare stocks to attractive, kind of into that attractive opportunity space. So the healthcare sector is one potential bright spot in what could be a pretty unpredictable economy next year. Kind of going to bonds then, we do think, while there's probably risk for equity markets, that could actually be a bit of a silver lining for fixed income investors. So, not only can these higher quality bonds offset some volatility, but we believe that yields look very attractive at current levels. Plus, bonds have historically tended to do very well in recessions and other stress market environments as rates tend to fall. And you can see kind of how they've compared to equities during this period. But you have to be very selective about picking your spots in fixed income markets. And how we're thinking about this is first, we're thinking about moving up in credit quality. So when rates were low, you had to take more risk to generate yield. But today, you have investment grade corporates yielding about the same as high yield or riskier corporates did for almost the entirety of the 2010s. So this could be a way to lower volatility, add some diversification to your portfolio, and really not sacrifice much at all in terms of yield. The other thing that we're very focused on is managing duration here. I mentioned this earlier. So there's two ways to think about this. First, if you're looking to maximize just your current yield without making a bet on rates going anywhere, then think about some short duration type strategies. Right now, you can get 5 to 6% yield without even kind of having to predict the direction of rates in the shorter duration part of the market. If you're thinking about maximizing total return, we definitely would say think about potentially increasing duration while staying within that higher quality part of the market. And the reason is that, at the end of rate hiking cycles, which we think we're at the end here, doesn't matter if you think it's going to cut, the Fed cuts in March or the Fed cuts in June, they're very likely going to cut this year at some point. And that really could create some reinvestment risk in portfolios that have been sitting kind of on the sidelines in cash or in really short duration instruments. So reinvestment risk is really just the risk that you wait too long. So when you do get into the market, you get in at a lower rate than what you could get right now. And historically, once the Fed hits its peak rate, which it stays there for around 4 months. And within 6 months, the Fed typically cuts by an average of 2%. And if I just, give you a hypothetical example, if rates were to drop by 2% across the board, with the duration of the Bloomberg Ag around 6 years, that could be in itself a one-time price gain of around 12%, all other things equal. And then you add yield on top of that and you start getting into, attractive double-digit returns, which is really, even more attractive when you look at it on a risk-adjusted basis. So adding some intermediate duration here may, help you just lock in some of those higher yields for longer. But, of course, very, very important to be nimble because this market environment is quite dynamic. So think about, we would think about maybe it's an opportunity to take a bit more of an active approach within your fixed income portfolios. And then I'll just kind of, the last topic I said I would touch on is diversification. I get that this question comes up very frequently because for the past, decade plus, investors really haven't had any choice but to accept more risk in their portfolios because you couldn't get any return on cash. Traditional fixed income really wasn't generating enough interest with rates sitting close to zero. The challenge now is that we kind of have to adjust to this new reality. I think that's one in where markets are going to be a lot more volatile, right? We talked about some of the risks being, election cycles, geopolitical risk. But we haven't, touched on the fact that, the effects of monetary policy actually tend to be lagging as they come through the system. So you can see in this chart, the full effect of every rate hike cycle really can take up to 18 months to be felt. That means that we expect it will take another 6 months for the full effect of Fed hikes to make their way through the system in this current cycle. And that would really kind of coincide with our view that we will start to see a slowdown in the first half of this year. So it's all just to say that, the risk-taking environment that has worked so well for many of us after the financial crisis just may not be quite as successful going forward in this new environment. So really think it's time to, embrace portfolio diversification. Fixed income is one way to do that. Over the very short term, we do also have a slight overweight to cash. Just taking some profits from a very, very healthy equity return last year and kind of waiting to see what happens on the economic side, especially in labor markets. And you can see that, cash yields actually look or stocks look expensive relative to cash equivalent yields at this point. So it's just a bit of a cautious view, but clearly, we do not recommend getting out of equities altogether. We're talking here about positions on the margin, not really taking huge bets, because the problem with taking very large bets, right, is you can be really right or really wrong. And we saw that happen in early 2023 when a lot of investors were significantly reducing their growth exposure and everyone was shifting into value because there was attractive valuations and the rate environment. We all know what ended up happening with the Magnificent Seven. You can imagine, a portfolio that didn't have that growth exposure probably did not fare as well as one that did. So bottom line, mixing stocks and bonds and other asset classes, it's a tried and true kind of, method, but it is still the best way that we know to address some of this market uncertainty and to really maximize your risk adjusted return potential over time. And those are things that are probably going to likely matter a lot in the coming year.
Elaine,
So, yeah.
you mind if I just jump in and ask
Yeah,
a question? I was wondering if we could just go back to the last slide. It just, a question came up and wondering, so if we look at this and we don't, we have this lagging impact of rates being higher. If we're thinking 6 months out and we're starting to push into the impacts not hitting until maybe September or even later, right? Is maybe kind of the risk environment not as strong because of that? Is there potential that, this year turns out to be steadier than we think and really that recession impacts start to push into 25? Is that a potential, or is it really we're going to see that slow down mid-year and it'll start to impact us, do you think?
I think that we expect that the slowdown will happen in the first half of this year. So I don't think it's going to be pushed out much further than that. But I think the total impact probably depends on, how many companies need to refinance at these higher rates. So if you have a longer runway and you don't need to refinance and you can hold out until the Fed starts cutting, then you're probably in a better situation than someone that's going to be forced to refinance faster. So it'll kind of depend on how some of those lower quality companies that have to refinance those debts manage through this period in terms of how significant of a slowdown we see.
Okay, thanks. I was just
Yeah.
curious.
But that's kind of, what I wanted to run through as a very high level overview, but I did want to keep this interactive. So happy to open up for questions at this point.
Great, good. Maybe we'll dive in. And again, for the group that's on the webinar here, please feel free to enter your questions into the Q&A, and so we can get to those, or I will start with sort of the questions that have come in already. Uh, if we think kind of beyond rates, maybe what are some of the most important indicators we should be watching for outside of the Fed's actions?
Yeah. So there's two really important things that we're looking at right now. The first is labor market. So the U.S. jobs market has been incredibly resilient, right? Overall employment numbers do look really good, but there's other indicators that suggest that labor markets may be a bit softer and that workers are not quite as confident as some of the overall data shows. So we saw in January, for example, I mentioned people not quitting their jobs as much. That survey kind of reinforced that. Year over year wage growth is also starting to decline. And we're watching claims very closely because we think if claims approach kind of 300,000, that would likely accelerate recessionary fears. So that's a key number. That probably seems, more likely if the Fed waits too long to start cutting rates. On the other hand, a soft landing is probably more likely if the Fed cuts several times before we start to see some of these cracks in unemployment market widen or get worse. Um, you know, Tied to labor markets, the other really important thing that we're looking at and following is consumer behavior. So consumers drive 2/3 of our GDP. So the outlook, really hinges on consumer sentiment and consumer spending. Historically, every single recessionary period since the 60s, we've actually seen GDP growth um, show positive in the 2 quarters before a recession. I mentioned that right at the outset, positive GDP numbers, that's happened every single time since the 60s. So this is not abnormal. But to look ahead, you want to see like, well, what's going to happen with the consumer going forward? And even just looking at what happened over the holiday periods, in retailers had to start sales much earlier and let them run much longer. Consumers were spending more on practical items like food and clothing, and they spent a lot less on things like jewelry and electronics. Most of the data we're looking at suggests that all of that excess COVID savings, right, all that stimulus money, et cetera, that's pretty much been exhausted at this point. So the health of the consumer and what consumer spending patterns look like from here will be very important in what happens with the markets. And then, of course, look for any signs of if a reignition of inflation. If that happens, that could significantly alter the path of Fed policy, and then we'd have to really reconsider this base case.
I wonder about that with rates, because we saw back in December when we look at there's a futures market for the Fed's projected rates, and when we look at that in December, the betting favorite was for the first rate cut to occur in March. I think we
Yep.
saw it about 80% in March. And now I look at the Fed Watch tool and it says that March is a very low likelihood, and we've pushed it out to May at the soonest. Are there things that maybe, do we think May is the right target for them to start cutting rates, or maybe is it later than that?
I don't know the exact date, right? I think that's
Mm-hmm.
very hard to predict, and you can see how hard it is to predict because everyone's kind of getting it wrong. What I would say is, well, we think you should take the Fed at their word, right? They are not ready to cut right now. And so, we have to ask ourselves, what would cause them to cut? One thing that could cause them to cut is inflation hits its target, right? And until the Fed is convinced that it's going to remain at that target, I don't think they're going to be happy that their fight against inflation is over. The latest inflation numbers, they actually came in a bit hotter than expected. I mentioned, core CPI is about 4%, or about 4%. That's twice the Fed's target. If you look at the reason that inflation has come down, it's actually because of disinflation in goods prices. So it's goods prices getting cheaper, but services inflation actually has stayed quite high. So there's some lag in that data, like how rent prices are
You,
accounted for, et cetera. But
I'm just wondering,
yeah, go
like
ahead.
on the services side, right?
Yeah.
Do we start to see more easing there with that slowing of the wage growth, right? I mean, people staying in jobs for longer, maybe we see some softening there because wage growth is kind of pulling back a little bit.
Absolutely. I think, that is really key. A weakening labor market is going, is kind of the key determinant in terms of, we think even more so than inflation for the Fed here. And, on that rent thing, that data always comes through with a lag. So we'll probably start to see some of those updated kind of rent projections coming through in the next 3 months or so. So we'll see if there's significant kind of data to say that yes, we've been successful in bringing that stickier part of the inflationary market down.
Mhm. Great. Well, maybe if we think of kind of moving past where we're at now
Hmm.
and looking at the next stage of the cycle, are there opportunities that start to present themselves as we shift kind of gears beyond kind of this looming recession?
Yeah, I want to go back to this chart that I showed here about small caps. So small caps are one of these areas that we're watching very closely. Our own kind of tactical forecast, they're moving a bit more positive on small caps right now based on recent momentum. We're not ready to jump in just yet because we're waiting for some of these macro signals to kind of reinforce that trend that we're seeing. Oh, sorry. But if you look over the kind of the medium to longer term, small caps historically do very well coming out of a recession. You can see returns upwards of 30% or more. They've historically outperformed large caps during these periods, but it does not come without risk. Small caps clearly carry much higher risk. So you want to ensure that, if you're incorporating them in a portfolio, you have the tolerance to kind of manage through what could be a bumpy period. Other sectors that are getting more interesting to us right now would be real estate, right? We've had these high rates really kind of hampering. Just look at the REITs market. It's been kind of gotten beaten down for most of the past 2 years. We saw a nice bump up in Q4, but as inflation starts to cool, as the Fed, kind of stops hiking, that sector has been kind of beaten down. So valuations there could start to entice people back into the market. We talked about debt refinancing a little bit before. A lot of the headlines about commercial real estate, I think, kind of miss some of the nuance. There's, commercial real estate actually makes up a relatively small percentage of the overall real estate market. And there's other opportunities like data centers and single family rentals that are very active and very attractive right now. And on the debt side, in commercial mortgage-backed security space, you see, we talked about spreads being super tight in some parts of the fixed income market. Here, spreads are actually very wide. So you're getting paid a lot for taking on that risk. And it's actually, a lot of these buildings have some time before they need to refinance. So you're getting kind of that premium, even though the companies have time to kind of wait this out and let those rates come back down before they're forced to go to the refi to the debt back to the debt markets again.
Maybe this is probably if this is a little bit too in the weeds, you can let me know here. But when thinking about small caps, right, and
Yeah.
we know historically coming out of a recession, they've done really well, but they can really be impacted by the higher rates,
Hmm.
right? And so if rates remain higher for longer, small caps can be hit pretty hard. And just curious, is how important is it to kind of focus on the profitable side of small caps, right? Where you have companies that actually make money. So is that maybe it's the value or what we'd consider kind of quality small cap? Is that where you guys are favoring, or is it kind of a broad? I mean, I guess growth would probably be the best coming out of the recession, but I think if we're looking to manage risk, do we want to be sticking to those profitable areas of the small cap market?
100%. I think that's a great question. So when you think about small caps, the reason that they tend to do fare more poorly when rates are high is because they need to borrow more money than large cap companies do, right? They don't have that cash or other markets that they can go to, so they have to borrow, and they're riskier investments, so they have to borrow at much higher rates. So it is challenging. You definitely want to focus on the higher quality parts of that market. Value is actually, I mentioned this small cap value being 10% below average. Typically, value during, coming out of a recessionary period is also quite attractive just because it's a bit of a beta play. And so that part of the market looks interesting. But in general, there are other trends that could be very supportive of small caps over the long term. So one of the trends that we're seeing is reshoring, or bringing jobs back to America. And typically this is a lot of that is small cap companies that are actually benefiting from that. So small cap companies are often the suppliers to those companies that are reshoring jobs. There's a lot of impact on communities and small businesses in those communities where you're building new plants, or like having more manufacturing activity. So this kind of reshoring back to America is a boost for small caps. I like to say, like, middle America is my favorite emerging market, because I think that's one of those areas that's kind of overlooked, and could be a significant kind of positive trend in the next few years.
They don't show middle America in our analysis when we look at countries, unfortunately for
Exactly.
us, but it might be a good opportunity. Maybe a sector that didn't do as well, we saw energy really outperform, and you did mention alternative energy during the presentation, but maybe touching on those two sectors, right, is that I think both of them often get caught in kind of momentum, right, where we see
Hmm.
people will pile into alternative energy, and then when it starts to do poorly, it's like kind of the I told you so moment, and then they move out of it, and then they move into traditional energy, which is what we saw in 2022, and then kind of not a great market for either sector in 23. I'm just curious, do you have some kind of thoughts on energy as we move forward? And maybe if you want to stick to either the traditional or alternative, either one. I was just curious where you think those are kind of headed.
Sure. Um, one of the craziest stats that I saw is not really related to your question, but just an interesting
Yeah.
uh, tidbit. Nvidia right now, as a single individual stock, actually has a larger weight in the S&P than the entire energy sector. Like, I think that's just wild in terms of, the Magnificent Seven, what we saw happen last year. Um, but in the short term, like, geopolitical risk always impacts, energy prices, in particular oil. Escalating conflict in the Middle East right now very clearly, there's a threat to disrupting energy infrastructure. There's an upside risk to energy prices if US or Iran gets more involved in this conflict. But those things are quite reactionary, right? As you mentioned, prices are going to fluctuate around some of those headlines. If we look a bit longer term, though, we're actually like positive on the energy sector over the long term, because we've seen a lot of improvement in business models within some of these energy companies. So in the past, energy companies really had this habit of they take all these revenues that they make from high prices and then they aggressively reinvest it in producing more oil, right? And so, that doesn't leave a lot for shareholders in the form of like dividends or share buybacks. But in this most recent cycle, we've really seen a structural change in how their management teams are allocating capital. So many of them have kind of capped their spending. They've given more back in terms of like cash flow to shareholders, and that feels more sustainable. You have to, of course, be very, very selective in which companies you're choosing within that sector, but it gives you an opportunity to identify companies that could really outperform going forward. You mentioned alternative energy, another interesting tidbit, it's interesting to me at least. The US is now the world's largest exporter of liquefied natural gas, right? We've surpassed Qatar, we've surpassed Australia. It's really remarkable since we only started like doing this in 2016, but demand for liquid natural gas as an alternative energy source has really been supported by Europe's kind of transition away from Russian oil dependence. And there's some very good companies capitalizing on this trade right now. We have this company, Cheniere Energy, which we've really been watching. They built the first liquefaction train. They're based out in Louisiana and Texas. And before they even make a decision to construct kind of new infrastructure, they typically pre-sell like 90% of that inventory. So it's a very attractive business model because it's transparent. You know that most of those sales are going to happen before the investment's even made. So yeah, there's a lot of hype about like, renewable energy. And I have an electric car, and I sat for like 2 hours waiting for a charger the other day up in Pennsylvania. So a lot of infrastructure work still to be done, and I think we're definitely not quite there yet, but parts of the market there's really interesting opportunities if you know where to look.
On the renewable side, is there something that reverses the trend where we're at now, where it's fallen out of favor? Are there market dynamics that maybe say, hey, this, or are we kind of in a waiting period now?
An escalation of the war in the Middle East and a significant increase in oil prices would probably be enough to do it.
To make the shift, to speed it up.
Yeah.
Good. Well, I guess if we're talking about conflict, it leads us into maybe something we've been avoiding throughout the conversation a little bit, but I have opinions on this. I'm sure you do, but just where do you think the election this year in the U.S. kind of impacts markets?
Yeah. So it's always a tough one because, we don't make calls, right, on like who's going to win or not. But there's a lot of research that's been done just generally on election years and the impact on stock markets. And so there's a couple of things that tend to happen. One, stock markets tend to be quite volatile during election years. So every election year, we see more volatility. But they've also been positive most of the years in an election year. So typically the period leading up to like kind of the primaries are the most volatile periods. Once the primary is over, we start to see some normalization, kind of going into November. I guess, I don't know if we think the primary is over or not. That's debatable. I guess we'll see what happens in South Carolina. But there's no specific like trends that you can really point to in terms of sectors that always do well. There's really no trend that you can point to in terms of which political party kind of is better for the economy. US stocks have really just over time tended to go up regardless of whether it's a Republican or a Democrat in the White House. So we kind of say, this is one where we try not to let emotions take over, kind of not be too reactionary. And really the best advice is kind of stay invested because you're going to have a much better outcome over the longer term.
Yeah, I think it's something we see a lot, right? There's nervousness around the markets whenever there's an election because you have a level of uncertainty. I mean, largely with ourselves, right? Depending on who you favor
Yep.
as a candidate, right? You have your own sort of anxieties around an election, but really the data seems not to be statistically, relevant depending on who gets elected,
Yeah.
right? Like whether it's a Democrat or a Republican, it's just something that happens and the markets kind of move along.
Yeah, and I talked about, we have this slight overweight to cash. I mean, we're talking on the margin there. What we do tend to see happen frequently in election years is investors moving all into cash because they're trying to avoid kind of that risk. But that is a risk in itself, right? If you think about where cash rates are right now, you've got 5%. If the Fed comes down another 2%, okay, now you're at 3, inflation's at 3%, your purchasing power is effectively, you're
Well,
not making any money at that point. So that's another risk. So just, kind of try to keep those things in balance.
yeah, I think we would just look at it as if your desire is to move to cash, there's likely a better opportunity in creating
Yeah.
stable income moving forward rather than having kind of that safety, right? Because
Yeah.
you have security in the bond markets that creates, positive long-term outcomes.
Yeah, and so there's a lot of really interesting short duration and ultra short duration products out there right now that can help you accomplish that. So,
Hmm. That's great. Uh, so maybe as we kind of near the end of the presentation, I'll hit you with my kind of favorite question here is just maybe what's something you're looking forward to in the markets moving forward, just you personally, or I'm sure you work with a team, of course, right? And so you guys talk about this, but as you sit in front of the team and you're presenting, maybe what's something that you're higher on in the markets?
I feel like every year we kind of say this is going to be the year for fixed income. We've said that the past few years and it really hasn't panned out. But I really do think like when you're looking at 15, 16% returns on relatively high quality bonds in the fixed income space, that is a incredibly attractive proposition that we have not seen in the past 20 years, right? We have not been anywhere close to this kind of opportunity. So I think this definitely is the year of the bond and in particular on the investment grade, higher quality parts of the corporate bond market. I think we see a lot of really interesting opportunities.
Well, I guess right to ask someone like, what's really exciting? You're like, bonds.
Bonds.
Right. Which I think the explanation makes perfect sense. I like the kind of the character of being excited about bonds and we haven't had that opportunity in
Yeah.
a long time, right? When rates and were super low and we were seeing, we used to purchase bonds and you got a 2.5% on a 5-year bond, you'd be excited, right? That was a great deal. And now we're seeing those rates much higher, obviously, and we do like that opportunity. So it is exciting. It's funny to hear bonds talked about that way, of course.
Yeah, I mean, most institutional investors, they have a 6 to 7% return target for their portfolio on an annualized basis. You can basically get that with very, very, very low risk right now. So it's just an opportunity we haven't seen in a very long time. And I think it's definitely worth kind of taking another look and getting excited about what's typically a pretty mundane sector.
Hmm. Good. Well, we're at about 50 minutes now. We'll give it about 30 seconds here if anyone wants to jump in with any final questions. And if not, we'll go ahead and we'll end the webinar. Uh, but Elaine, I really want to thank you for your time today. Thank you to American Century, of course. It's always great, getting to work with you all, and we really enjoyed the presentation. With that, anyone, if your questions weren't answered, if you didn't get a chance to put them in the Q&A, please go ahead and forward them to us here at the team, and we can pass them on to American Century, or we can try our best to answer them ourselves as well. But once again, Elaine, thank you for your time, and thank everyone for joining us today. We look forward to checking in soon. Thanks
Thank
again.
you so much. Appreciate it. Take
Thanks.
care.